Yeah, but hundreds of European banks have applied to borrow money from the European Central Bank in its first ever offer of unlimited 3-year loans at very low cost. The take-up for the $500 billion offer was far higher than anticipated. For more on this, we're joined now by Oliver Hartwich of the Centre for Independent Studies. Oliver, welcome. What effect will this have?
Well, they're trying to solve the banking crisis because European banks are facing massive problems in the year ahead because they have to shore up their capital. They have new regulations for capital adequacy. That means they have to shore up a lot of capital until June next year. And the European Central Bank is now jumping into the market and offering them a lifeline, if you like. And so the lifeline is 500 billion euros at the moment.
Will the lifeline work?
Probably not, because it's not enough money, because the Bank for International Settlements, for example, estimates that in order to meet the requirements by June next year, European banks are looking at closer to 2.5 trillion euros. So even the 500 billion, it sounds an enormous amount of money, is not enough to make up for that.
So when you say it's a lifeline that won't work, what will happen if the lifeline doesn't work? Will these banks fail midway through next year?
No, I think what's more likely to happen is actually that we're getting a second and a third lifeline further down the track. So the European Central Bank has now started this process, and it's probably very difficult to actually get these European commercial banks off that lifeline again, because they're now getting used to that. And they're trying to take it again and again and again. And of course, they've got now the potential to put pressure on the European Central Bank and effectively blackmail it into giving it more money.
So what will be the end result of this endless lifeline of billions of dollars?
It's very hard to predict, but what the European Central Bank actually wants to do is it wants to achieve two things. It wants to stabilize the banking sector on the one hand, and it also wants to help European governments. And you could already see the first effects. Spanish government debt, for example, is down 1.5%. The yields on Spanish government debt.
Over what period?
All over the last week, actually.
Yeah, okay.
So what's happening, or what the European Central Bank actually wants to see happening more, is that these banks take the money and invest it straight into European governments.
But there was a feeling that maybe they weren't going to do that to the extent that the European Central Bank wanted the banks to.
Well, and effectively, they need a lot more money for that too, because as I said, banks need 2.5 trillion euros to shore up their capital by June next year, but European governments also need another 1.6 trillion euros next year. So this is really just the first step, and I think there are many, many more problems down the track.
When banks start printing, or when there's a perception that banks are printing money like that to keep things going, it's all going to end pretty badly, isn't it?
Not necessarily immediately, not next year perhaps, but I think we're building up inflationary pressure down the track. It could well be that we're not going to see an outbreak of inflation over the next year or two, but further down the track, somebody has to deal with these enormous quantities of money that are now being printed.
There was commentary early this week that Greek was headed for default sometime this week. Analysts were expecting that, or within a couple of weeks. What's your sense with Greece now? I know you've been saying for a while that the Europeans should just basically cut it loose.
Well, it would almost be ideal, wouldn't it, to do it over Christmas, because at least it gives you a few days how to sort out things. Seriously, if there's one time when a country should default and when it should perhaps reintroduce its own national currency, it would be the Christmas break, because it gives you some breathing space, but I doubt that the Europeans are actually going to do it.
But in terms of a Greek default, how does that work practically? What actually happens?
Well, I think in terms of a Greek default, we are talking about really a Greek return to their own national currency, because a Greek default on its own doesn't make sense if Greece is still stuck with the euro currency afterwards. So I think we're going to see two things eventually. Greece will default, they will take their haircut, or they will simply say that they can't pay anything at all anymore, and then they will introduce a new currency at the next day, because otherwise they couldn't borrow in euros anymore and the country would really be reduced to collapse.
Okay, Oliver Hartwich, no doubt we'll be talking to you again about this issue. Thanks very much.
Thank you.